Hey everybody, here's yet another instructional video. This time we're going to talk about cumulative preferred share dividends. Okay, so the word cumulative here suggests that they're going to accumulate over time. So when you were walking through and reading through the content, I hope you realize that a dividend is a share of the company's profits that are paid out to shareholders. And if you're a preferred shareholder, you get your dividends first. Preferred, you're preferable, you get it first before the common shareholders. Okay, so in this case, accumulative preferred shares are going to be paid no matter what. Okay, it just depends on when you get paid. So our scenario is going to be this: we got two guys named Bob and Doug. Okay, they're preferred shareholders in a public company. They own 1,000 shares that are $5 cumulative preferred shares with a stated value of $10. Now I'm just going to stop for a quick second and go over this. What I want you to realize is that this $5 here is not the value of the share. Okay, so let's read this again carefully. $1,005 cumulative preferred shares. This is the dividend amount. So for every share that they own, they're going to get a $5 dividend. That's what that number means. Some people in the past, when I've taught this course, they get those mixed up with the stated value here. This is the price that they was either they paid for it or maybe they paid a little more and there was a contributed capital on top of things. But this number here that comes just before the words cumulative preferred shares, that itself is your actual dividend. Okay, I want you to keep that in mind. That's an important fact that we'll get back to later on. Okay, well, that's Bob and Doug. And then you got Laverne and Shirley. They are common shareholders and in the same company, and they own 50,000 common shares with no stated value. Now, notice I haven't given you the value, how much they paid for these stocks. That's a transaction that's happened in the past. We're not so worried about that in this case. We're just going to worry about the dividend. Okay. So the question is this: what is the journal entry if there was no dividend paid in 2013, but there is a $25,000 dividend paid in 2014? Well, in 2013, no entry. Okay. However, Bob and Doug are going to be owed their dividends because they have cumulative dividend preferred shares, pardon me. And that means that even if they don't get paid in the year, they're still owed that dividend. Now, we don't make an entry for it just yet because the rules apply with preferred shares that they do with common shares and dividends, that there has to be a certain date that's made. So in 2013, we don't make an entry about this, but you have to kind of put this in the back of your brain that, hey, wait a second, those two shareholders, Bob and Doug, they own preferred cumulative shares. That means that they're going to get paid later on when we do pay out a dividend. So they're owed, okay, $5 times 1,000 because they own 1,000 shares over here at $5 each. So they're owed $5,000 in dividends. All right. Now, again, we don't make an entry in 2013. We wait until 2014. Wow, could have written that worse. 2014. Okay. In that year, there is a $25,000 dividend. Okay, so what we want to do is we're going to have two entries, just like we do with the common shareholders. There's a date of declaration. Okay, so when the company actually comes out and says, yes, we're going to pay out a dividend, that is your first entry that is your first journal entry in calculating dividends. So we're going to have two debits, cash dividend, preferred shares, and then a cash dividend to common shares. Okay, both accounts that are going to get closed out to the retained earnings section of your ledger. All right, and then finally, what we're going to do is we're going to credit an account called Get Dividend Payable, which is a liability account that is going to be temporary until we actually pay out the $25,000. All right, so on the date of declaration, you're going to have a cash dividend, preferred shares, a debit to cash dividend, common shares, and a credit to dividend payable. All right. Well, look, what's the credit to dividend payable? Well, that's fairly simple. That's going to be $25,000 because we have promised to pay these guys $25,000. So here's where the trick comes in. I'm going to make a little spot over here if I can. Do a quick calculation. And I'm going to put a star over here so you know that's my calculation that I'm working on here. Here's where the preferred shares come from, or the value of it comes from. In 2013, as we showed above, they owed $5 grand. Okay. In 2014, they haven't changed the number of shares that they own. The cumulative amount hasn't changed, so they're owed another $5,000. That gives us 10 grand. So Bob and Doug are going to get a cash dividend of $10,000. The remainder has to go to the common shareholders, Laverne and Shirley. They get the 15,000. All right. So to account for dividend declaration. That's your simple little explanation. All right. So when the day comes that they actually pay, the date of payment, very similar. In fact, it doesn't really change from what you learned with common shares in some of the content. We're going to debit dividend payable, the liability account, because we no longer owe this money. We're paying it out, and you credit bank for $25,000 each. To pay dividend to shareholders should be your description. Okay? So let me underline that. Okay? The date of payment. All right? And that's it. The key, of course, is right here. Okay? This idea that in 2013, we didn't pay them, Bob and Doug, because they're cumulative preferred shareholders. That means they still get that $5,000. That doesn't change. In 2014, they get another $5,000, which is where our $10,000 comes from. That gets placed right there. Okay? That's it. That's pretty straightforward, I think. If you got any questions or anything, let me know. Okay? Thanks.